Welcome to the Teenager's Guide to Wealth. In this video, we will show why starting young is the single biggest financial advantage you can have. We will cover simple investing strategies, key accounts like the Roth IRA, how to think about lump sum versus dollar cost averaging, building an emergency fund, and practical steps you can take this week. Let's begin with a quick but important disclaimer. Before we dive in, this content is for educational purposes only and is not financial, tax, or legal advice. Because you are a minor, you should involve a parent or guardian in any account opening or financial decision. Rules and contribution limits can change, and returns are never guaranteed. With that in mind, let's move into our roadmap. Here is our agenda. First, we will explore the time advantage and why starting now changes the math. Next, we will establish index funds as your foundation. Then, we will compare lump sum investing versus dollar cost averaging. After that, we will examine the Roth IRA and its tax benefits. We'll also set up a safety net with an emergency fund. Finally, we will conclude with a simple action plan and a couple of quick quizzes. Let's start with the power of time. Starting now gives you decades of compounding. The earlier you invest, the more time your money has to grow on itself, which is known as compound growth. Rather than trying to time the market, prioritize time in the market. Investing small amounts now can become substantial sums over several decades. With that principle in place, let's build a simple but powerful foundation. For long-term growth, broad market index funds are one of the simplest and most effective approaches. Your current S&P 500 ETF captures large U.S. companies, which is a strong start. To broaden that, consider adding a total U.S. stock market fund to include mid and small caps. Then include a modest allocation to international stocks for global diversification. Low-cost funds reduce drag on returns, and automated contributions keep you consistent. Now that the foundation is set, let's map out the order of operations visually. This flowchart shows the path your money should take. You begin by building an emergency fund and a high-yield savings account. Next, if you have earned income, you open a custodial Roth IRA. Then you choose low-cost index ETFs, such as a total U.S. market fund, plus a slice of international. After that, set up automated contributions. Periodically rebalance to maintain your target allocation. A decision point asks if you need the money in less than 3 years. If yes, keep it in savings. If no, invest. Finally, stay the course through market ups and downs. With the roadmap in mind, let's tackle a common debate. Here we compare lump sum investing and dollar cost averaging. Lump sum investing means you put the full amount to work right away, which historically outperforms about 2/3 of the time because markets tend to rise over long horizons. Dollar cost averaging spreads purchases over time, which can reduce the emotional impact of volatility, and may be better if you are nervous. If you do not need the money for a decade or more, lump sum is statistically favored. Otherwise, DCA can help you implement a plan you will stick to. Now, let's focus on the most powerful account for teens with earned income. A custodial Roth IRA allows teens with earned income to contribute after-tax dollars that then grow tax-free and can be withdrawn tax-free in retirement. You will need a parent or guardian to open the account. Inside the Roth, buy low-cost index funds for long-term compounding. Because you are starting early, each contribution could compound for 50 years or more. Next, let's shore up your defenses with a proper emergency fund. Use this table to size an emergency fund. Multiply your monthly essential expenses by 3 for a basic buffer or by 6 for a stronger cushion. Keep this money in a high-yield savings account, so it is liquid and accessible for unexpected costs such as car repairs or medical bills. Only invest dollars you do not need in the short term. With safety in place, let's present a concise markdown recap of a simple allocation. Here is a simple markdown summary of a straightforward allocation. Target an 80% total U.S. stock market ETF and 20% total international stock market ETF. This approach provides broad diversification at low cost. Maintain it by automating contributions, rebalancing periodically, and staying disciplined during market volatility. Now, let's turn this into an action plan you can follow step by step. Follow these 7 steps. First, calculate your monthly essentials to set your emergency fund target. Second, open a high-yield savings account and automate transfers until you reach 3 to 6 months of expenses. Third, if you have earned income, open a custodial Roth IRA with a parent or guardian. Fourth, Select low-cost index ETFs to match your target allocation. 5th, automate contributions and consider lump sum investing for windfalls you do not need for at least a decade. 6th, enable dividend reinvestment and schedule periodic rebalancing. 7th, keep educating yourself and avoid letting spending grow quickly with income. With the plan in place, let's test your knowledge. Question: which approach historically beats the other about 2/3 of the time for long-term money you will not need for 10 or more years? Options are lump sum investing, dollar cost averaging, picking individual meme stocks, and holding cash until the market dips. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is lump sum investing. Historically, because markets trend upward over long periods, investing sooner tends to outperform spreading purchases out, although dollar cost averaging can help with emotions. Now, let's try one more quick question. Question: what is the best account for a teen with earned income who wants tax-free growth and tax-free withdrawals in retirements? Options are regular taxable brokerage account, traditional taxable savings account, Roth IRA custodial, and College 529 plan. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is a custodial Roth IRA. With earned income, you can contribute after-tax dollars that grow and can be withdrawn tax-free in retirement. Next, let's reinforce the main ideas with key points. These are the key points. Start early to harness time. Use low-cost index funds for broad diversification. For long horizons, lump sum investing often outperforms. Use a custodial Roth IRA for tax-free growth if you have earned income. Build an emergency fund before investing short-term dollars. Automate, rebalance, and maintain patience through market fluctuations. To visualize the journey over decades, let's look at one more diagram. This timeline highlights compounding across decades. It begins at age 16 with the first contribution, then shows how growth accumulates by age 26 after a decade, age 46 after 3 decades, and age 66 after 5 decades. If invested inside a Roth IRA, withdrawals at retirement can be tax-free, amplifying the benefit of starting early. With the visuals complete, let's summarize the roadmap. In summary, start now to maximize time in the market. Build your emergency fund in a high-yield savings account. Use low-cost index funds with both U.S. and international exposure. Favor lump sum investing for long-term money. If you have earned income, make the most of a custodial Roth IRA. Automate contributions. Rebalance periodically, and continue learning. Now let's wrap up with a quick thank you and a call to action. Thank you for watching. If this video helped, please like it, share it with a friend who is also starting their financial journey, and subscribe for more content. In the comments, share your first action step for the week and any questions you would like answered next.